All right, welcome back, BAccSc CTA and SAICA candidates. You are officially in the final stretch of mastering one of the absolute most critical areas of the Income Tax Act, the General Deduction Formula, or GDF. Today's explainer is a fast-paced, high-yield session focused entirely on specific transactions. But we aren't just going to rehash the theory here. We're going to decode exactly how this source material shows us to extract maximum marks in your tax exams. Okay, let's dive right into this. Here's our roadmap for today. We're going to kick things off with business and intangible transactions, and then jump into people, losses, and legalities. From there, we'll unpack a bulletproof 8-step exam technique, test it out on a master exam scenario, and then wrap the whole thing up with a rapid-fire revision checklist. Okay, part 1, business and intangible transactions. Let's get to it. Now, this is an area where examiners relentlessly test your grasp of the capital versus revenue divide. It's all about noticing how quickly a deductible Section 11A revenue expense can flip into a prohibited capital expense. Take advertising, for example. General advertising qualifies under Section 11A, assuming it meets the GDF requirements. But if that advertising creates a permanent asset, like, say, building an entire model house just to exhibit some furniture, well, that's capital, and it's prohibited. You literally cannot just expense an entire house as a flyer. And if it's a donation with zero business purpose, not deductible. Sponsorships, however, are deductible for their commercial value. Next up, education. If you're simply maintaining existing knowledge, like attending SAICA CPD courses, that's deductible. But the second you improve or acquire brand new knowledge, you're creating an enduring benefit, which makes it capital. Finally, goodwill. Outright acquiring goodwill is capital. However, if your actual business model is the profitable resale of businesses, then that cost is deductible against the proceeds. Plus, annual payments for the mere use of goodwill that reverts back to the owner, that acts like rent, so it's revenue in nature and deductible. When we're talking about intangible assets like patents or trademarks, the whole crux of the matter lies in one very specific distinction. The initial registration or outright acquisition of a patent is capital. Why? Because you're acquiring a permanent income earning structure. On the flip side, paying annual royalties just to use that patent is revenue. The crucial test here is the enduring benefit test, which was famously confirmed in the BP Southern Africa 2007 case. So expenditure to acquire an asset that creates an enduring benefit is capital, for sure, but recurrent expenditure for mere use, which doesn't create any new asset, naturally assumes a revenue character. Moving right along to Section 2, people, losses, and legalities. Let's look at how this applies to the inevitable risks and costs of employing people. Staff are obviously essential to producing income, but man, they are expensive. Generally, amounts paid under a service agreement are deductible if the GDF is met. But beware, any excessive portion driven by motives other than trade is going to be disallowed. Reasonable annual bonuses to keep staff motivated, deductible. But bonuses for past services, not deductible because they aren't producing future income. Bursaries are an interesting one. They're deductible if the employee is actually obliged to work for the employer after their studies. Same goes for termination lump sums. If it's a general policy, it's deductible. If it's just for past services, it's not. Now pay close attention to Provider v. COT principle. This is a game changer. It established that voluntary expenditure incurred specifically to induce employees to enter and remain in service qualifies as a deduction because the ultimate purpose is to produce current or future income. So, what happens when things inevitably go wrong? Let's talk damages and compensation. We have two incredibly important contrasting cases here. First up, Jaffa & Co. This tells us that paying damages due to negligence is only deductible if that negligence is an inevitable concomitant of the taxpayer's operations. Basically, if it's not inevitable, it's not in the production of income. Contrast that with Port Elizabeth Electric Tramway. Here, the question is simply, is the action giving rise to the expense closely connected to the income-earning activities? Think about a driver crashing a transport bus. That is an inherent, unavoidable risk of running a transport business, right? Therefore, it forms part of the cost of performing the operation, so it's deductible. Listen up, because this right here is exactly where candidates drop easy marks. Let's tackle losses first. If you lose a fixed asset to fire or theft, that is capital. There is no Section 11A deduction. But if you lose trading stock, it is deductible, though only to the extent that it exceeds your insurance recovery. Now, what about cash embezzlement? This is fascinating. If the managing director or owner steals cash, it's not deductible. But if a subordinate employee steals it, it actually is deductible. Tax law practically assumes subordinate theft is just a regular inherent risk of doing business, which is a little terrifying if you think about it. Next up, legal expenditure. Always check Section 11C before you even think about attempting Section 11A. Legal fees spent protecting an existing source of income are not deductible. Fees to acquire a capital asset, capital, but legal fees spent to purchase trading stock or to actually earn income, those are revenue in nature and fully deductible. Let's rapidly run through loyalty points and excessive expenditure. To claim an expense, it must be actually incurred. The Labatt case tells us that expenditure requires a diminution of assets, so merely awarding a loyalty point, that isn't a diminution. Edgar's Stores dictates that there has to be an unconditional legal obligation. Nationale Purse goes further, stating there must be a definite and absolute liability. And Caltex Oil reminds us that expenditure is incurred in the year the liability arises, not necessarily when the cash is paid out. So putting that all together, for loyalty points, the expense is only actually incurred when the customer actually utilizes or redeems the points, not the moment they're awarded. Oh, and a quick reminder on excessive expenditure. If an employer pays an excessive salary, the unreasonable portion is disallowed for the employer, but it remains fully taxable in the employee's hands.
All right, Section 3, the 8-step exam technique.
Look, knowing the theory is absolutely useless if you can't apply it under exam conditions. The source material outlines a fail-safe framework, starting with these first 4 foundational steps. Step 1. Check if a specific deduction applies first. If not, explicitly state you're using the GDF under Section 11A, read with 23G. Step 2. Confirm the taxpayer is actually carrying on a trade. Step 3. And this is a massive pitfall. You must explicitly list all 6 elements of the GDF. Expenditure and losses, actually incurred, during the year of assessment, in the production of income, not of a capital nature, and laid out for purposes of trade. Do not skip that. Step 4. Identify the specific issue in the scenario and link it to the exact element in question. The issue is never just, is it deductible? The issue is specifically, was it in the production of income, or was it actually incurred? Now, steps 5 to 8, that's where you secure the big marks. Step 5. State that the element in question isn't defined in the Act, so case law must be referenced. Step 6, name the relevant case and clearly state its principle. Step 7 is absolutely crucial. Rigidly apply that specific case principle to the unique facts of the exam scenario. Merely reciting theory earns you nothing if you don't apply it to the facts at hand. And finally, step 8, conclude clearly on whether the requirement was met and if the amount is deductible. Section 4, Master Exam Scenario Application. Let's put this to the test. Okay, always read your instructions and allocate your time based on the marks provided. Here is our master scenario. A retail company carrying on a trade has 4 specific transactions in the 2026 year of assessment. 1. They pay damages to a third party injured by their delivery truck driver. 2. They pay legal fees defending their registered trademark from a competitor's infringement. 3. They award our $50,000 worth of loyalty points to customers, none of which have been redeemed by year-end. 4. On the 1st of March 2026, they pay a $120,000 prepaid sponsorship for an event happening continuously over the next 12 months, getting their logo displayed. Their year-end is the 31st of May 2026. Let's break these down. Let's walk through the model solution for the first 2 items. For the damages, you start by stating the GDF elements. You identify the issue, in the production of income. You bring in Port Elizabeth Tramway and Jaffe. You state the principle. Is the risk of a delivery accident an inevitable concomitant of a retail delivery operation? Yes, it is. Then you apply it. Employing drivers inherently carries this risk, making it closely connected to income-earning activities. Conclusion, deductible. Boom, marks awarded. Now for the loyalty points. The issue here is actually incurred. You cite Labatt and Edgar's Stores. The principle. There must be an unconditional obligation and a diminution of assets. Application. By year-end, the points are unredeemed, meaning the liability remains conditional. Conclusion. Not actually incurred, so not deductible yet. Marks awarded. Now for part 2. Let's look at the legal fees. First, you check Section 11C. Does it apply? No, because the expense is to protect a trademark, which is a capital asset. So under Section 11A, the issue is not of a capital nature. You state the principle, expenditure protecting an existing capital structure is capital in nature. Application, defending a trademark protects the income-earning structure, not the income-earning operations. Conclusion, prohibited deduction. Finally, that prepaid sponsorship. It qualifies under Section 11A as advertising, but wait, you have to spot the Section 23H trigger here. The R$120,000 is for 12 months, paid on March 1st. By year-end, May 31st, only 3 months have passed. The benefit clearly extends beyond the year of assessment. So does Proviso AA apply?
No, the remaining 9 months extend beyond 6 months after year end. But does Proviso BB apply? Well, the prepaid portion is R90,000. That does not exceed the R100,000 threshold. Therefore, Section 23H does not limit this deduction. The full R120,000 is deductible this year. That is an excellent trap to watch out for.
Finally, Section 5, our revision summary and checklist. We're in the home stretch now, so let's do a rapid-fire review of those core triggers. Advertising, deductible unless it creates a permanent asset. Patents, acquisition is capital, mere use royalties are revenue. Damages, deductible only if an inevitable concomitant of trade operations. Education, maintaining knowledge is deductible, acquiring new knowledge is capital. Employment, service agreement costs are deductible, past service bonuses are not. Goodwill, acquisition is capital, right of use reverting to the owner is revenue. Legal, check 11C first, then 11A. Protecting a capital structure is prohibited. Losses, subordinate embezzlement is deductible, owner embezzlement is not. Continuing that checklist, loans, business advances are deductible on e-recoverability, while employee loans are capital. Sale of debts, selling to a finance house for cash is deductible, but selling after ceasing trade is not. Loyalty points, only actually incurred when utilized or redeemed, not when simply awarded. And excessive expenditure, the unreasonable portion is disallowed for the employer but remains fully taxed for the employee. You absolutely must walk into that exam hall with this case law arsenal loaded and ready to go. BP Southern Africa for enduring benefit versus mere use. Jofi for the inevitable concomitant of negligence. Port Elizabeth for actions closely connected to income-earning operations. Provider v. COT for inducing employees to stay. Labat for the strict necessity of a diminution of assets. And Edgar's Stores for the unconditional legal obligation. Which brings us to a final critical question. When you're sitting in that exam hall, staring down a complex transaction, ask yourself this. Have you rigorously linked your specific scenario facts to all 6 elements of the GDF? Because knowing the theory is only half the battle. Proving the application is how you actually become a master. Good luck with your studies, keep focused, and we'll see you in the next explainer.